Okay, so we're talking about now, we're at the stage here where we want to project the number of shares to finalize our projections. And we talked about the idea that we have to go to the front page of the most recent report. And let me give you a complete perspective. Okay, so let's assume that this is way back in 2013 when I was putting together the book. And at that time, Walmart had released one annual report. And the annual report was as of December 31st, 2013. Okay? And so what I want to do is I want to go to sec.gov. And I want to say, what was the most recent report? When I say report, I mean K or Q, financial report, as of the current time. So this was, I believe we put this together in October 2013. So I'm going to pull up the company filings. Company name, I'm going to do the ticker is easier, WMT. Okay. And let me just confirm what I'm saying here. I'm going to pull up, I want to know the print date. This is getting in the way here. Look, that's the more. So the annual report, so I believe, yeah, the annual report doesn't, okay, right, I just wanted to confirm this. So I believe the book was published in October 2013. This was at that time where this annual report was obviously year-end 2012. And so we did have some quarterly reports that have come out between December and then the current date, meaning from the perspective of the book, which is October. So there is at least a Q1, a Q2, maybe even a Q3 that had come out. And so we don't use that for our financial data because we want an annual model, so we're going to use the last annual data. But for projections, if you want as current a share count as possible, okay, we're going to go to, and I'm going to say, I'm going to pretend that we're back in 2013, 09 to 1001, okay? I'm going to assume this is where we're at. And at the time, there was 3 quarterly reports that came out. All right, so I'm going to go to the documents of the quarterly report, and on the very front page, I'm going to see, right here, the register had X number of shares outstanding as of September 3rd, 2013. That's the number of shares that I use. Okay, now, in the book, what happened was, if you take a picture of this, what happened was, in the book, this might have been an amended report, because in the book, the number was a little bit different. So let's use the numbers in the book, but this is where it would come from. And actually, in the book, I cut and pasted this, and you'll see the numbers have changed a little bit. But this is where you're going to get that information. And in the book, so we can use the book numbers, they had the numbers 3361, 444, 307. Okay? So those are the number of shares, a little bit different. Okay? And a couple things. First of all, that's the actual number of shares. And what you would do is you would round them to match the units here. You round them into millions. But let's not do that yet, because I want to use those actual number of shares to dilute them based on a method called the Treasury Method. Okay? Okay, 3361444307. Okay? The Treasury Method converts the stock options for us. And let's talk about that a little bit. that in there. And so what we want to do is we want to search for all the stock options that are outstanding and exercisable. How do we do that? We got to dig through all the filings. It's a pain. Now, I'll say this, that might make it easier. One thing is 10Q reports usually are not extensive enough to talk about options. Only the 10Ks. So we start with 10K reports. And you want to look for tables. There are usually 3, maybe a little bit more, categories of options you look for. Employee stock options, warrants, restricted stock. Employee stock options, regular stock options, warrants, restricted stocks. Sometimes they're in 3 separate tables. So you just got to do a lot of digging. Do a word search on options and restricted stock and look for all those tables. And you're looking for the number of shares outstanding and at what price are they exercisable, based on what I talked about yesterday about stock in the money or out of the money. Okay? So let's do that. So we're going to go back to the CAT. I'm going to start with the annual report. I'm going to look for options. Okay, they talk a little bit about options here, but I'm looking for tables. I'm really looking for tables. They would have things laid out in the table. Keep going. And again, I'm doing this quickly, but it took me a long time to get this, and I found this table. Now, we're lucky with this table, and you're usually luckier in bigger reports because they're simpler, where they have 3 types of options: stock options, a performance-based restricted stock, and another type of restricted stock, where in a lot of companies, this might be broken up into 3 different tables. So you got to spend a lot of time. This was in doing comps and in doing models, in diluting stock options. This was a painful process. We're lucky here, and I know that this was it because I spent a lot of time going through the reports. They laid 3 tables out into one for us. Okay? It's one thing. The second thing is, notice there are 2 totals. There's the number of options outstanding, meaning the ones that have not been exercised yet. But there's a subset of that, a smaller subset. Of those outstanding, which ones are exercisable? Why would there be stock that are outstanding and not exercisable? Why would you think?
It's not in the money.
Maybe they're not in the money. However, here's the strike price of each, and the current price was $78. So they were both in the money. So why else?
Is it bail time something?
Say that?
The bail or something? Just like time period you cannot exercise your...
Restricted based on time. For example, employees who get stock options and they say you can't exercise them for 5 years. Something like that. Probably time restrictions. So if there is outstanding and exercisable, you want to use that. You want to look for outstanding and exercisable. If they don't mention exercisable, then you assume all the outstanding are exercisable, meaning they don't have time restrictions. So, but if you say exercisable, you want outstanding and exercisable. This is the total number of options exercisable at 5049. They made it simple for us. But in reality, if this was broken up into 3 different tables, you'd have to use this number, and then you'd have to look for the second table and use this number. You'd have 3 different numbers. But they amalgamated it for us. Okay? So what we're going to do now, just realize you might have to do it using 3 different tables. We're going to do it in 1 table. So let's do it, and I'll show you how to do it with several different tables. And so what you'll do is, okay, so there's 13,596 million options. We're going to go to our table, and we're going to say number of outstanding options in the money, 13,596. Now, look at the units. The units are off. This is millions. These are actual numbers. So I'm just going to bring this out to millions by multiplying by 1,000. I'm just going to say 0, 0, 0. Okay. Okay. And at what price is it exercisable? We're going to look. $50.49. Okay? $50.49. Okay? Now, this is the tricky part. So let's do this with the one table, and then show you how to do it for several tables. If we want the diluted number of shares outstanding, do we add these two numbers together? Do you add these two numbers together at all to get the total number of shares outstanding?
You mean diluted?
Yeah.
No.
No.
Depends on the price, I think.
Yeah.
Your strike price and the current.
Exactly right. Why?
Because it's the option is out of money, so you will not come in.
Okay, but these are all in the money.
Oh, about restrict the time. Restrict time.
These are the subset that have no more restrictions and can be exercised today.
Oh.
All right. Now it might change.
Wouldn't you want to make your model flexible according to the share price? Because the share price might change, right?
You could make this a little bit more flexible, but just in terms of how the Treasury method works, which is what I want to get to. Is this the number of shares outstanding right now?
No.
Okay.
Yes. No, because it's
Yes or no?
no.
Yeah.
No. Yes.
Yes.
Yes. No. Maybe.
Yes.
Possibly.
Number of outstanding options, so it should be outstanding, right?
But they're contracts.
Yeah. So it wouldn't, because this is at a point in time, right? So it wouldn't have, like, if we're doing it now because it was in the past, wouldn't the conditions already changed, or is that not?
You are correct, but there's some other reason why that does not represent the actual shares in the market.
Because it's not traded by publicly, just
Okay, why not?
why not? Because somebody or maybe the company issued this one for some special group investor, and that's just they have this right to exercise or not.
You might be right, but you're overthinking it. These stock options, 13 million. When exercised, what will happen to them?
It's European or American? From
Let's assume they're American.
They'll become inside the market.
How many? All 13 million? Anybody online?
Isn't it depends to strike price?
Why? It does.
If somebody strike price is different than the other one, some of them may consider to exercise, but some of them may not consider to exercise.
Let's assume they all consider to exercise.
If they exercise, that will be kind of the outstanding.
It would not be.
It will not be.
Why? If you were an option holder, this is what confuses a lot of people, so I'm going to try harder to explain it better this time. If it locked? No.
Sorry.
You just got to turn your hand on. If these exercise, if I were an option holder and I were to exercise these in the market, okay, what would you do? It's $73.84. $73.82. Let's put this in. Current price at the time was $73.82, and that should be blue. Okay. At $73.82. Okay. If you were a holder of one of these options, you have the ability to buy a stock that has this value for $50, right? So what would you do? You would exercise, Right? I mean, you might not, you might hang on to it, but we are assuming for the diluted share calculation that you will exercise. Okay? What will happen when you exercise that stock?
Oh, the stock price will go down.
Yeah, I mean, for a lot of people, it might go down. That's a different concept. Then we'll talk about that in a minute. Just the mechanics of any stock option issuance. What will happen?
The company has to give you the stock. Depends
Yeah,
on how
they do.
many. Depends on how many stocks they own.
Let's
right
say you
now.
have one. What will you do? You will say you have the ability to exercise this stock for $50. You can pay for a stock at this value for $50, right? So you will exercise in the contract.
So wouldn't it be the share price minus the strike price?
Yeah, but what does that mean? Correct.
That
Yes.
means that that's how much you're gonna profit that you're gonna receive.
You're going to take a profit.
Yeah.
Yeah.
You're going to take a profit. So exercising the contract means I can pay for this stock. I get this stock that is this value for $50.49, right? It means nothing to me until I sell it back in the market.
Yeah.
This is the tricky part. This is where a lot of people get confused. So if I have the right to exercise to pay $50.49 for this share, I'm not executing, completing the trade. I'm not making money on this until I sell it back in the market at $73.82.
Yeah, makes sense.
So what happens is 13 million option holders are going to execute at $50 and expect the market to buy it back at $73. We are assuming that whoever exercises at 50.49 is going to do it to make that profit on the spread.
Nice.
This is the Treasury method. It always confuses me. I'm trying to take extra effort to explain it a little bit differently. And we're going to exercise it fully in M&A. But the point is, the number of shares outstanding at the end of this transaction is going to happen once everybody's exercised and then sold it back into the market. Okay? So this is what we have to do. We have to figure out the proceeds of the options being exercised, which is a product of taking the 13 million times the 50.
Oh, sorry, this information you take from the 10K or?
10K. Yeah. So there is $686 million in proceeds being exercised. Okay? The market buys it back at the current price, right? So now I have to say, okay, how many shares were bought back? That's the 686 divided by 73. Okay? So of the 13 million contracts exercised, 9 million are bought back in shares. The value of shares left outstanding is the difference. That's how the Treasury method works. That's the number of diluted shares. You have to become familiar with that. It confuses a lot of people. This is the number of diluted shares, 4 million. We will work on this. Wow.
Sorry, can you get back to the cell 58, D58, the Treasury method shares with the I just see the form.
Yeah.
It's like, got it.
I cannot put the dollar symbols on my Excel. Something's wrong.
Your share price?
Yeah,
No.
right, can you show 'em?
No, you don't. You don't put dollar signs, the formatting itself.
Yeah, it's a format. Yeah. If you type the dollar sign in, it'll. Sometimes it'll assume you mean formatting, but.
It doesn't work. Yeah.
No, you are in the wrong cells. It should be. It should be here. Right here.
Oh.
Different. Yeah. You want to put it in the wrong column.
Can you explain why it's share repurchase by dividing 9 million by the share price?
Should type
Is it like what's the matrix? Yeah, so that like so is that the line item that we're assuming that they're selling it back to the open market?
Yeah. Is that correct? I know. It's confusing.
How do you calculate option receipts?
That's the multiplication. 13 million times 50.
Oh, that's the one.
Busy numbers. No.
Okay.
So the proceeds is what the company paid, or to the investors, or the total option proceeds is what?
The total option proceeds is the value of the contracts at the strike price,
Yes.
which means nothing until they sell those back at the open market at the current price.
Okay. Let's assume that, because you're taking the average price here, right, for the strike price options, right?
Yeah.
But then, let's say that like a mature company has a lot of different types of options at different types of strike prices, right?
Yeah.
Just average that.
Yeah, so this is what I had started to say. So, okay, so we went back and we looked at how to dig it up in the annual report, right?
Right.
So if this had been separated out into 3 tables, okay, you would do this 3 different times. So this is number of outstanding options in the money A and their strike price A, okay? And then we would I would do it underneath, but let's just say options B, and you would have like 15 million.
Okay.
And then you have strike price B, and now it would be at $20. Okay. And then we would take the proceeds of those options, okay, and divide it. We'll do the same thing again. Okay. Whatever that comes to be. Okay. And then we would calculate the number of shares there, and we would add that to the total. These are the additional shares outstanding based on options B. Okay. So you would just repeat this process for every table that you find of stock options. Then at the end, the diluted shares is the basic shares plus the additional shares from options A, the additional shares from option B, the additional shares from option C.
Okay. So let's just say you change the strike price to say 80, which is now like to $80, which is now above now it's not in the money. Then how does that? Would you have to subtract it out, or
Then there's no value. Zero. It doesn't get included.
would there be like a formula for that, or like an Excel formula for it? Or?
No, you wouldn't include it in here.
Wouldn't include it. Okay.
You could do an if statement if you wanted to, and we'll get into like if statements and switches and that, but in this situation, it doesn't make sense to even include it at all. Okay? So the total diluted shares outstanding is the sum of the basic plus the additional we just calculated. That's the diluted number of shares. Now, what you have to do is, based on how this question, which is a good one, we did this based on one table. We got lucky with Walmart because Walmart had everything together, all the different tiers of stock options together. You have to spend a long time word searching, everything we talked about before, to find every single table that might have outstanding and exercisable options. What you also have to do, to be completely accurate, is, based on what we did earlier, if the K report that's released was months ago, and in this case it was 9 months ago. You have to go back to every single filing and see if they've issued more options and include that in your analysis. It's a pain. It takes a long time, yeah.
Every report.
Yeah, I mean, there's clues, so we'll slowly get familiar with. 8Ks are announcements. So there would usually be an 8K or 13Gs. You can look at the total. If it's vague, like current report, you have to click it. Usually it would say registration of stock options, and you know. I actually went through it, and they didn't register any new stock options, so it was easier. But you have to spend the time, and it takes a couple hours.
But wouldn't it be updated in the most recent 10K, like in terms of?
Yeah, but this most recent 10K was 9 months ago.
Oh, okay.
Yeah, so if you want something as of today, which we do, because we're making projections.
Yeah. So then you're going to go through forward, but not back.
You go for it. You go for it. You gotta go for it. Everything from that most recent report. Now, ideally, you'd say, well, they have a Q that was released 8 months before, but the Q reports usually don't have the options detail. Only the K is usually. If you find option tables in the Q, then great. Then you just got to use that, and then you'll have to look like 1 month in the book. So you got to be a little bit careful about time. Okay, so that's the Treasury Method. We're going to hone in on this very important in M&A, which we're going to talk about. This stuff will get linked into our projections. Okay, we want to project the number of shares, which is going to be equal to the basic number of shares that we have outstanding, but we have to divide by 1 million. Okay, to get to common units. Divide by 1, 1, 2, 3, 1, 2, 3. Right? 1 million. Okay, the number of shares went down. We're going to talk about how to handle that. There was a buyback. We're going to have to model that through into the cash out. We'll talk about that.
How do you get the 61? Guess I get you. Oh, got it.
And the diluted shares is that divided by 1, 1, 2, 3, 1, 2. Okay? Got it? Okay? And then we copy to the right, and we look at the earnings per share. Okay? Do you guys have that? Now, why the jump? Why from 5 to 7? $2 increase. It's your question.
Well, because your share count is going down, right? Which will bump up.
Yeah, but that wouldn't bump it up $2. That's partly correct. So good point on that. Something else. Trick question. A little silly.
Difference in the option price and the share price?
Indirectly. You're right. This is a very, very small part. That's not going to impact $2. A little more obvious than that.
Is it because net income and the calculation for that we haven't adjusted and the net income and the net is too high?
Why is it? Yes. Why?
I think we haven't made projections on some of the things.
We left out a bunch of expenses.
Yeah.
Once we put them in there. Now, this brings up a very good point. Remember when we talked about going to that analyst report table? Again, I want you to build the skills of how to think like an analyst, think like an associate. It's not about throwing numbers in here, right? How to make good projections. And remember, we pulled out this analyst report online that had like an average of 30 analysts, right? You remember that? We did that yesterday. They had 2 metrics that they often project, revenue and earnings per share. So my recommendation, to be very efficient, as a first cut, without wasting time doing research yet until the model is done, is first like what we've done. Get revenue.
In line with the average. And we first did that by taking last year's growth and seeing if it falls in line with the average, and if it doesn't, then we tweak it so it falls in line with the average, right? If 30 analysts on the street predicted to be around 470, I think it was 2.5, or we were close, we should not deviate further than that unless we know something they don't, right?
And then my recommendation is this. Take as a first cut every single expense as a percentage of revenue from the year before, okay? And then see what EPS comes out to be. Because EPS is also a number, the other number often reported by analysts. And if we're using the same revenue projections as the street, our EPS should be in line with the street. Because this is what the street does. If our EPS is much higher or much lower, that must mean the street has collectively made some sort of major cost adjustment that we didn't see. And this is the big thing about modeling as a technique as opposed to just running it through in a crash course, because this is what the street will do. And my point is this, as we build the model, we will realize, if we go up from the bottom, if this was way off from the street, what could be different? Tax rate is not going to fluctuate much. Okay, we'll realize this. This is the skill I want you to have in the back of your mind by the time we're done with week 3. The interest numbers should not move unless the company had a major debt issuance or a major debt paydown. Why would interest numbers change? What else would move this? Depreciation, we will realize. Look at the way it's historically changing. It should never
Jump or drop unless there is a major company divestiture. It always climbs steadily.
So most variations in assumptions come above the EBITDA line. And what is that? Revenue, COGS, and OPEX. So if your revenue is in line with the street and your EPS is not, now you know when you get on an earnings call on behalf of NYMEX or behalf of New York Bay or behalf of CEDAR or whatever, you now know what to listen for. Well, why is my EPS different than the street? And if my EPS is too high, then you know but my revenue matches, there must have been some adjustment to COGS or OPEX. Now you know what to listen for. Was there a major cost-cutting initiative? Or was there a major minimum wage increase? Was there pressure from manufacturing prices that would cause cost of goods sold to go up? Now you have a smarter way to look at the projections and think about reading between the lines to understand what adjustments might be made to get to an EPS that falls in line with the street's EPS. That is a first cut way to make good projections. Okay. So the answer is A, because if your pricing is increasing, that's going to go straight to revenue. When units increase, 20%, that'll be offset by the cost of goods sold increase, it'll be a wash, and of course OPEX won't impact anything this position. Okay. Now, we're done with the income statement. Okay, on to the cash flow. By next week, Monday's a holiday, we've covered chapter 1, right? We're going to start to introduce chapter 2, but in a way where there's not going to be much reading assigned to it. Just if you have anything to focus on chapter 1. If you're comfortable with it, great. But there's an important transitional element that I want to think about, which depends on what the cash flow statement is. Okay, what is the cash flow statement? What's the purpose of it? Well, I'll illustrate that. Let's say we got a small distribution company. Let's say the company books $10,000 in revenue, okay? And it has various expenses. We'll lay out the expenses in a second, right? So the expenses plus taxes bring its net income down to $2,100, right? $2,100 in profit. And this is its income statement. Kind of tough to read. I can zoom in. You have the flip slides there. You know, 10,000 in revenue, 2,500 COGS. It's got general administrative, fuel, depreciation, taxes, 2,100 net, right? So let's say this company is a trucking company. Small startup, it's like one guy. He's got a truck, he drives around, picks up packages, he delivers. Let's say he has some engine troubles with his truck, right? And he has repairs that cost $1,000. I said, okay, fine. You got $1,000 in repairs, I made $2,100 in income, I can fund it. He goes to his bank account, he doesn't have $2,100, he has $100. Why?
Not all the cash is received.
Not all the cash is received. So this is why we have a cash flow statement. An income statement is what's been booked and recorded, different than what's actually changed hands in cash. This is why investors prefer looking at the cash flow statement. This is why we have a discounted cash flow analysis, not a discounted net income analysis, because cash is what the company is actually tangibly being produced. Why is there a difference? Okay, let's analyze it. So, a cash flow statement sets to talk about of the profit that we've generated, how much of that is actually cash? And I'm just going to say, how much of that do we actually generate? So let's look at analyzing that. I'm going to take all the major income statement components. Okay, we have revenue, we have COGS, we have OPEX, which get this EBITDA, we have D&A, we have interest, we have taxes, we have then, did I hit the major pieces? Probably. Right? Now, let's analyze all these income statement line items and figure out which of these line items could potentially not result in actual cash. How about revenue? Is revenue always cash?
No.
No. What's the portion of revenue that's not cash?
Accounts
Receivable. How about COGS?
That's not all accounts payable.
Could be accounts payable, could be inventory. We're going to talk about that next because that confuses people. Let's just simplify for purposes of this analysis. But we'll talk, it could be accounts payable, it could be inventory. It could be accounts payable / inventory. We'll talk about the differences depending on how it's recorded. OPEX. You get a bill, you don't pay it yet.
Accounts payable. No
Accrued
payable.
expense.
Accrued expenses. There's a difference. We'll talk about the difference. Accrued expenses. Okay. Depreciation amortization?
No,
Never cash. We'll put D&A, meaning it's always, this is a theoretical item. We'll talk about that next week. Depreciation is the accounting for the aging of an asset. It's an item that you can use to deduct taxes, but it's never, you don't write a check, depreciation to anyone. Interest, you assume is always cash. If you're not making these payments, you're defaulting, you have bigger issues. Okay, so there's no adjustment. Tax,
How about accrued expense? Accrued like interest expense, possible.
that's the other way around. This is for, we'll talk about that.
same thing.
Josh, right? Tax based. You can defer some taxes. You accrued interest expense is also a problematic situation. We'll talk about way towards LBOs. Not standard in any business. Deferred taxes. Okay. There's also one other line item I want to add later. We talked about a little complicated other income. Right? And you could make adjustments potentially based on other adjustments. I just want to add that just for a technicality. Other. Okay? So if you look at this,
I mean, I'll adjust it because your other income will be better.
yeah, other income, not the interest. No adjustments to interest. I stand behind your defaulting account of your interest. This is cash from operations. So I want you to know where cash from operations comes from, because towards the end of the program, you're going to have to learn how to build your own cash flow statements. Cash from operations is your net income plus deferred taxes, depreciation, other, and changes in working capital. This is working capital. We're going to talk about why next week. This is depreciation and amortization. This is other. This is deferred tax. If you look up the formula for cash from operations, this is what it is. Net income plus deferred taxes plus depreciation, amortization, change in working capital, other non-cash items. Why is that what it is? Because you're basically trying to back into, from the net income, what line items are non-cash. That's the foundation of the cash flow. It's more than that. That's the foundation. I want you to know why that is, because you're going to be dealing with companies that are be honest here. A lot of times you are asked in business school to memorize this formula. I want to make sure you know where it comes from. So, getting back to this example, let's say the company had $10,000 in revenue, and we dug deeper into that revenue, and we realized some of that revenue is on credit, meaning they didn't get the cash from that yet, $3,500 of that. So if you take your net income of $2,100, and you say, okay, how much of this is cash? Well, $3,500 of that I didn't get. Okay? I'm going to minus $3,500. Okay? You see why I'm minusing that? Cost of goods sold, let's say I paid that. General administrative I paid. Fuel I paid. Let's just an example. Depreciation, I never paid. So this was an expense that brought my net income down. When I think about cash in my account, I never actually paid that.
That's what you could.
Yeah, so I'm going to add that back. Taxes, let's say I paid everything. So I take 2,100 minus 3,500 plus 1,500. This is why I only have $100 in my bank account. So we have a problem. We'll figure out how to fix it by deferring taxes. But my point is, if you take each line item and think about what's deferred, this is a good way to interpret into cash. Okay? Cash from operations. Cash from operations is the cash generated from net income. Net income plus depreciation.
In deferral tax can be plus at that time because we don't pay, we defer it.
Correct. Yep. Any expense they didn't pay, you add back.
Yes.
Revenue they didn't get, you subtract. Yep. Now, the cash flow statement is a measure of how much cash has been generated or spent. It's actually three major categories of cash. Okay, so you got to start to think about that. The first major category is the cash from operation. It's this. Of the net income generated, how much of that is cash or spent in cash? We talked about how to analyze it. We'll focus on it more. The next category is the cash from investments. How much cash was spent from investments, for investments, or received from investments? And the major categories within cash from investing activities is CapEx, most important. It's the money spent for the improvement of or maintenance of your property, plant, and equipment. Really important in DCF, I'm sure you've heard of CapEx, capital expenditures. Other important areas within the investing activities is asset acquisitions, M&A, asset divestitures, or investing in securities. If the company has investments in securities, they're buying and selling stocks in the portfolio, you're generating money on that. That's investing activities. Money generated or spent from buying or selling property and investing in securities. That's your investment activities. Very simple. Third category is financing activities. Cash received or spent from, I think of as three major areas. Debt, equity, distributions. That's the way I like to think of it. Three major areas. It's money received or spent from raising or paying down debt, money received or spent from raising equity or buying back equity, and then 3, paying out equity holders, paying out distributions. That's the financing activities. This should give you a complete picture of how cash has changed hands, where cash has gone. So what we will do is we will take and figure out cash from operating activities based on our income. You're going to figure out how much cash was spent and received from investments, and how much cash was spent and received from debt, equity, or distributions, and the sum of those 3 is a measure of how much cash you generated in a year. That's the cash flow statement. In a very, very simple form. We're going to spend quite a bit of time on that. Any questions? Okay, I want to take a 10-minute break. And